Hi you guys, welcome back to Progressive Sisters Magic, and today we're going to be continuing lesson 6 with a technical analysis of cryptocurrency, okay? And we'll be going over the core principles for trading crypto. So we're going to go ahead and jump right into it, and we're first going to be going over support and resistance. Core principles of technical analysis: support and resistance. Support and resistance are the backbone of technical analysis. They are like invisible floors and ceilings where prices often stop and react. What is support? Support equals a price level where many buyers step in because they believe the coin is cheap. It prevents the price from falling further, like a floor. Example: Bitcoin drops many times to 20,000, but each time buyers jump in and push it back up. That's a strong support level. Stock example: Apple stock drops to $100 multiple times, but big investors keep buying. $100 becomes its support. So support levels are areas of higher demand where traders usually enter for a position. So basically what I mean when I say that is that these traders are anticipating a reversal, okay? A reversal of this downward trend. So they're buying in when it's super low, expecting the price to go up even higher. They're seeing it as a sweet spot, is what I've heard a lot in the cryptocurrency world. It's a sweet spot on where you want to enter your trade because you know it's going to go up, okay? So another thing that we say in trading is buy low and sell high. So essentially your support levels are like your discounted levels, okay? That's where you want to get in for a lower price so that you can make profit off of the upward trend that you are expecting to happen. So these support levels are reducing the downward pressure that the market is experiencing at that moment. And I do want to let you guys know, support levels is not just like a line. Like, oh, if it goes below this line, then that means that, you know, it's going to turn around from a downward trend to an upward trend. No, that's not exactly what it means. While it can be a line, like a certain price range, it's literally just a zone, okay? So which can equal a few prices in between that zone. So when it hits that support level, you're thinking it's going to reverse, okay? So it's not necessarily just one price in one line that you're looking at. It's a zone and it's a range that you're going to be looking at for these support levels. And one way to properly identify these support levels is looking at the previous data of whatever you're trading. So if you're going to be trading XRP, you're going to be looking at the previous price data and trying to see at what point or what level did the price touch always before it rebounded and changed direction, okay? So that could be whether it's be a downward trend or upward trend. What price level did it hit before it reversed, okay? And what price level does it continue to hit, or what zone and range does it continue to hit before it reverses the trend? And accurate support levels are usually found on the higher time frames, like the daily or the weekly. Those are the time frames you're going to be looking at for these support levels. Now, if you're a sniper, like a scalping trader where you just trade on the 5 minute, the 10 minute, 15, then you can be looking at different time frames for your support levels at that time. But in general, when you're trading, when you're doing a swing trade or a day trade, you're going to be looking at the daily and the weekly time frames. Now let's go over the opposite of support levels and get into resistance levels. What is resistance? Resistance equals a price level where many sellers step in because they think the coin is expensive. It prevents the price from rising higher, like a ceiling. Example: Bitcoin rises toward 25,000. But each time sellers sell heavily and push it down. That's a strong resistance level. Stock example: Tesla stock climbs to $300 but falls to break above it multiple times. $300 acts as a resistance. Role reversal: resistance becomes support. If price breaks above resistance ceiling, that level often becomes new support floor. Similarly, if support breaks, it can turn into resistance. Example: Bitcoin breaks above $25,000 resistance, then falls back to $25,000. Now traders see it as a new support. Real world analogy: support equals floor. Drop a ball on the floor, it bounces back. Resistance, ceiling. Throw a ball up, the ceiling stops it. Price acts like that ball inside a room, bouncing between floor and ceiling until it breaks out. In crypto charts, certain levels hold strong buy and sell orders. When these support and resistance levels are broken, it signals the beginning of a new trend in the chart. Okay, so based on that definition, you can see that resistance levels are literally the complete opposite of support levels. So they're using these resistance levels in a sense as signals of the market, okay? So these signals are signaling that the price is too expensive, okay? So what goes up must come down is what these traders are realizing. So when you have something that's too expensive, you're going to assume that the price is going to drop eventually, okay? That's why I absolutely love the example that we used on the school app with the ball representing the support and the resistance levels. So when you drop a ball on the floor, it's going to literally bounce back. That is the support, okay? That is the support levels. Now resistance is the ceiling, okay? So when you throw a ball up, it's going to hit that ceiling and it's going to fall down, okay? So support is the floor, resistance is the ceiling, okay? So that is a very good scenario for you to think of whenever you get confused about support and resistance. And the reason why I am stressing so much about remembering what support and resistance is because that is how you become a really good trader, is tracking those support and resistance levels. You're no longer gambling and just thinking of where the price is going to go or when you can enter a trade in to be profitable. No, you're having clear direction on what type of trade you should be putting in and where you should be entering, okay? And that is because you're going to those higher time frames and you're going to the historical data and you're marking up your charts with those lines, with those bars, with those circles, with those triangles, whatever you decide that you want to do. There's so many different tools for you to use on TradingView to mark up your charts how you see fit, but you recognizing support and resistance levels is key to becoming a very profitable trader. So resistance is driven by traders thinking the price is too high, profit taking, and institutional selling. So what I mean by institutional selling is, you know that these institutions, they are the ones who drive the market. We can have all these different economic, micro effects on the market, but the true people who really manipulate and drive the market are going to be these institutions because they are trading with like humongous volumes, okay, which are going to disturb the market and drive it in whatever direction they please, okay? So what I mean by profit taking is essentially when traders are seeing that the price is really up there, they know that it's going to hit a ceiling and that it's going to go down. So they're going to take their profits while they can. They're going to pull out and profit off of the price going up to where it did hit that ceiling before it decided to have a reversal. They're going to take it, okay? Now, that can be a tricky situation when it comes to trading and when it comes to investing as well, because one example of this is when Bitcoin hit like $20,000, right? A lot of people saw that and was like, oh my God, Bitcoin hit $20,000. I'm going to take out my money. I'm going to essentially sell my Bitcoin, essentially is what they did. And I'm going to keep the profits that I made. Wow, $20,000 is a lot. You have to remember that Bitcoin later on hits for an all-time high of $126,000. But because they took their profits early, they only made a profit of however it was when they bought it to $20,000. So you have to understand that you really have to read the market. You can't be convicted by FOMO, which is a fear of missing out, okay? Don't have that conviction. Actually look at the markets, look at the trends, look at the support, the resistance, look at everything as a whole, like the macro and the micro economic factors, and really gauge on what you want to do with that trade or what you want to do with that investment, okay? Make smart decisions, okay, you guys? Don't make off the fly decisions, because I'm pretty sure the people who sold their Bitcoin at 20,000 were very upset when they saw that it hit 100,000 or 126,000 or however high it continues to go in the future. So when it comes to understanding resistance and support levels, you have to understand, while you have a resistance level, that doesn't mean that it's absolute, concrete, and forever, okay? Those resistance and those support levels change on the daily. Multiple times a day it's going to be changing. Actually, like really a lot of times during the day it's going to be changing. Now, when I say by that is when something hits a resistance level, it typically is supposed to go down. But if it hits that resistance level, that ceiling, and it continues to go up even further, that's considered a bullish trend now. It's breaking structure, it's continued a bullish trend, and it's going up, and it's going to create other different resistance and support levels. So that past resistance level is going to turn into essentially a support level, and then it's going to create a new resistance level, which is going to be its ceiling, okay? So this is all things that you really have to take a deep dive in and understand to be able to understand the charts and where the price action is going. And the same exact thing goes for support levels. Support levels can be broken, okay? And those support levels can turn into resistance levels. Remember, when a support level is broken, that means that the price is going to be driving down. It's going to be a downward trend, which is going to be a bearish breakout, okay? So that support level is turning into a resistance resistance level and it's going to create a new support level whenever the support levels show a breakthrough. So when these support and these resistance levels are broken through, whether it be to the upside or the downside, that means that it is creating a new trend, okay? And now we're going to get into what I mean by the word trend. Trends. Traders have a saying, the trend is your friend until it ends. Understanding trends help you to trade with the market instead of fighting against it. Markets usually move in 3 ways. Uptrend, bullish, higher highs and higher lows. Example, Bitcoin climbing from 20K to 25K to 30K. Downward trend, bearish, lower highs and lower lows. Example, Ethereum dropping from 4,000 to 3,500 to 3,000. Sideways, consolidation. Price moves within a range. Example, XRP stuck between 45 cents and 50 cents for weeks. So, you guys, you want to trade with the smart money. You want to trade with the market. You never want to go against the market. Now, a lot of people, well, correction, some traders do trade against the market and they do make money. They are profitable. But as a beginner trader, especially, that should not be your strategy, is trading against the market. You need to trade with the flow of the market. So it's easier to understand, it's easier to grasp until you can make a new strategy for yourself to trade against the market if that's what you choose to do. But I don't recommend it. But this is not financial advice or anything like that. I'm just telling you what I do. And I trade with the market. I trade with smart money, which means I trade with the same way that the institutions are going. Because at the end of the day, these institutions are the ones truly moving the market. Now, what you're going to hear a lot in the trading world is bulls and bears, or a bullish market and a bearish market, okay? So let's first go over what a bullish market is. A bullish market is an upward trend. That means the slope is going up, okay? The price is going up, all right? That is what a bull trend is. Now, when you have a bearish trend, it's literally the complete opposite of bull, okay? That means it's a downward trend. The slope is down. The price is going down. Usually when there is a bearish trend, that means that there is a lot of selling pressure. But when there is a bullish trend, that means there is a lot of buying pressure, okay? So when a price is in consolidation mode, which means it's sideways, there's really not a lot of price action that's going on, not a lot of movement that's going on. If the price suddenly goes up, like boop, it goes all the way up, that means that the bulls stepped in, okay? Which is going to make it a bullish market. That's what you're going to hear a lot. Now, if you're in consolidation and then you see the price, it goes down, like it takes a huge dip, that means that the bears stepped in and they created a bearish market or a bearish trend, okay? Bulls are to the upside, bears are to the downside. Now, a price or a coin does not have to always be in consolidation mode in order for it to go up to a bullish trend or down to a bearish trend. You can literally be in a bullish trend on the upside, have a break of structure to the downside, and it creates a reversal, and now you're in a bullish trend. Okay, you're in a bullish market. That's just how it goes. So you don't have to be in a state of consolidation and sideways and then have to wait for it to go in one direction. No, it can literally be going this direction and then boom, this direction. Boom, this direction, boom, this direction. Okay, that's called a reversal. But if you are trading in today's time, and when I mean today's time, I mean since like November of 2025 to now March of 2026, you understand that the markets are looking really crazy, really choppy, really unpredictable, okay? So sometimes it's really hard to tell if we're going to be in a bullish trend or a bearish trend at the moment because there are so many price movers and manipulations happening to the market. Like, you guys, I know NASDAQ isn't considered crypto or anything like that, but I was looking at the NASDAQ chart and literally it had one candle on the 5-minute time frame that was the biggest candle to the upside that I ever saw in my life. Came out of nowhere. Came out of nowhere. And it didn't make a trend. It didn't make a trend. It didn't make a bullish trend. The price just started consolidating after that. Okay, so it's like it didn't create a trend. It was just a big price move out of nowhere, like the biggest price move I've ever seen out of nowhere. Okay, so it didn't necessarily create a bullish trend, but it was a bullish price action is what happened. A bullish candle is what it was essentially. And for something to be a trend, it has to be consecutive, okay? There has to be confirmation. There has to be repetitive, like, candlesticks going in favor or in that direction, okay? You can't just have 2 candlesticks and be like, oh, we're in a bearish trend. Also, when a trend is considered in consolidation, that doesn't mean that there's necessarily no price movement. It kind of means that the bears and the bulls are like, you know, they're creating what they want to happen inside of the market, because in order to have a buy order, you have to have someone on the selling side, and in order to have a sell order, you have to have someone on the buying side. So you have to like kind of correlate with each other, not actually correlate with each other, but there has to be somebody who's matching your trade essentially in order for it to actually get placed and put through. That's when liquidity and things like that and volume come into play when you are inside of these trends. Now let's touch a little bit on the bullish trend again. So you're going to have higher highs and higher lows. So that means that the chart is going to look like this. It's going up. So this low right here is going to be taken out by a higher low. All right. This low right here is going to be taken out by a higher low again. So, and then also on top of that, you reach a higher high. So the price got up to this point, but then it reached another point. So now you have another high, and then it got to another point. You have a higher high, and then another high, and then another high, and then another high. Now, bearish trends are completely the opposite. You're going to have a downward trend, so it's going to be starting here, and it's going to be going down like that, okay? So you're going to have lower lows and lower highs. So that means that the price is just dropping, okay? So when it was high right here, it dropped right here. So now this is the highest, but then it dropped right here. This is the highest. Now it dropped right here. This is the highest, okay? So that is literally how it goes. So lower lows, lower highs for a downward trend, which is going to be a bearish trend. Higher highs, higher lows for a bullish trend, which is going to be an upward trend. Now let's talk about how to essentially illustrate those trends on a chart. Trend lines and channels. There are guidelines on drawing trend lines and channels to identify and confirm trend direction. A simple rule traders should follow when drawing trend lines is connecting at least 2 significant price points, highs and lows. Then the line is drawn further to the right of the chart. The presence of a third point can further validate the trend line. A channel shows support and resistance points over a period of time. It is created by drawing a connected line from highs to highs and lows to lows. If the price moves within the channel area, it's considered a trend continuation. If the price moves above or below the channel, it can be interpreted as a trend reversal signal. So when it comes to trend lines and channels and things like that, you can do all of those configurations on your TradingView account, okay? Remember in the last video, I went over TradingView, how to get set up and things like that, how to customize your charts. So you can choose what kind of trend lines or what kind of objects you want to represent a trend. That is perfect for you and your visual representation of how to understand it, okay? So there is a plethora of different tools on TradingView for you to practice and just kind of fool around with and see what works with you. So I won't go into deep detail about the trend lines and the channels because I want you guys to go on TradingView and actually look at it yourself, visually see it, and customize your charts to your liking so that you can actually see the trend lines, the lower lows, the lower highs, the higher highs, and the higher lows, all those kind of things like that. Make them connect together and really make sense of these charts. Now there are a few examples on the school app and the lesson on the school app that's showing you a downward trend line and an upward trend line. I want you guys to take a really good look at those charts and literally look at those charts and try to practice it on some other charts that you may see fit, like XRP, Ethereum, Bitcoin, anything on your TradingView account, and draw those lines, those upward trend lines, those downward trend lines, and things like that. And remember, a trend is multiple candlesticks, okay? It's not going to just be 1 or 2 candlesticks. No, that is not a trend. That is not a trend. And while you're at it, go ahead and draw those support and those resistance levels as well. Those areas, those ranges of when the price hits it and it goes a different direction, or when it breaks out of that. Just kind of really play around and take all the information that I taught you today and apply it to the charts, okay? You're not going to remember this. It's not going to work if you don't actually go and apply it in the real world. Apply it on a chart that is live and ready for you, okay? You don't have to open up a trading account and just put money in there and all that stuff to be able to see these charts and draw these charts. No, open up a free account on TradingView and mark up those charts. And now that you have a great understanding of what I taught you from part 1 and part 2 of lesson 6 when it comes to volume and trading analysis and fundamentals, I want you guys to go ahead and go to lesson 7, okay? Lesson 7 is a deeper dive into what we just talked about. I'm going to be talking about chart patterns. Now, you're not going to understand anything about chart patterns if you have not marked up your charts and actually played around and labeled your charts and things like that based on everything that I told you about in lesson 6. When you get to lesson 7, if you haven't done that, it's going to sound like complete gibberish. Okay, you guys? So even if you already know how to mark up your charts and everything like that, it's okay to practice. You can never practice too much, okay? Go ahead and practice again. So when you go into lesson 7, you already have a foundation and a really good grasp and understanding on what I'm talking about, because I'm literally just going to be going into a deeper dive of what I talked about today. But when I say deeper, I'm going to be like much deeper. We're talking about continuations and expansions and consolidations and everything like that. So you guys first understand everything that I talked about in part 1 and 2 of lesson 6. Now, if you are ready, we're gonna hop into lesson 7. Okay, you guys, we are moving pretty fast. You guys are so smart. You guys are grasping this information. All I ask for you to do is go and practice on those charts. Okay, you guys? Now, with all that said, let's move on to lesson 7, which is going to be about chart patterns.